All right. I think we're live. Anybody here yet? All right, we'll wait a little bit to let people join. Welcome to everybody hopping on right now. Just started here, so we'll wait a few seconds to let this pop up on everybody's feeds. Thanks for everybody hopping on. Give me a thumbs up or something if you can hear me, making sure my audio works. Can you guys all hear me all right? All right. Thank you. All righty. I normally do these normally don't do these live streams, but over the last couple of weeks, I've wanted to do them every time we have something kind of breaking happening. So we're getting that right now today with the dollar, the DXY, the dollar index has been skyrocketing and everything else has been falling as a result here. So that is what we are going to be talking about today. Why the dollar is going up, what's going on with the rest of markets. Everything is kind of collapsing here. Let me get my screen share going. All right. All right, so right now we are looking at the DXY, the dollar index, and this is a daily chart here, so we can see the dollar. It's up about 1.5% today, which, as you can see historically, that is a massive move up for a single day in the dollar. Remember, the dollar index DXY, that is a measurement of the value of the dollar versus other currencies. And so it's not a measure of inflation. It's a measurement of the dollar's value versus a basket of other currencies. So when we look at what's going on with DXY, we can see that it's skyrocketing. Now that a lot of people say, like Jeremy, it looks like, just said that the dollar index doesn't mean anything. And for the average American, it's really not going to do much other than when we get a day like today, asset prices start falling off a cliff as a result of the dollar going up. And we're going to explain some of that relationship today. And also, it doesn't mean anything for inflation, right? Because your dollars for the stuff that you buy are worth less every single day. So it doesn't matter if the DXY is going higher, is getting stronger. It doesn't matter for you if the dollar is getting stronger versus other currencies, because you're not trying to buy other currencies. You're just trying to make ends meet and buy stuff. If we take a look at the weekly chart here, let's actually move to the monthly chart. We get a better view here. All right, so if we look at this monthly chart here, we can see that as we broke above this 103 mark on DXY, there's really not a whole lot of resistance here. We might be hitting some resistance back here from 89 and back here from 76, but really we don't have a whole lot until we hit 120 here. And so we've got a lot of room upwards for this to go. And we were fighting this resistance here from basically 2015 for a while here. The dollar hasn't been this high since the early 2000s. And so this is really an indication that the pain that we're seeing in the markets right now, technically speaking, can last a lot longer. We can easily see this dollar. There's not a whole lot preventing it from going a lot higher right now, technically speaking. Again, dollar versus other currencies. So why is this a problem? Well, number one, let's go back. Number one, this is a problem because literally everything is just getting crushed, right? Let's go back to a daily chart. Stock market, red. NASDAQ is actually up a little bit now. It wasn't earlier. Dow is getting hit hard. Russell 2000 is down. Bitcoin is down. Silver is down 4%. If you take a look at this break here, just we could easily hit $18 per ounce on silver here after we broke down below this 20 mark. So silver's taking a big hit. Gold is taking a big hit. We broke down below this support at this 1780. We're down here at 1760. So things are taking a big hit right now since the dollar is going up. We are seeing VIX, the volatility index, is a little bit higher. It's been trending higher recently as well. And then the only thing that is going the same direction as the dollar is bonds, right? So that's why we're seeing a little bit of a sell-off or a little bit of a lowering in interest rates in yields that have been going down because bonds have been getting purchased. So part of this has to do with the fact that investors are bracing for the likelihood that the Federal Reserve that we're entering into a recession. Things are getting harder, right? And so right now, investors are trying to decide, hey, does it look like we're going to get a 180 from the Federal Reserve, or does it look like they're going to continue on this path? And that is the big question right now. Let's look at some articles. All right, so this is from today. A recent study by the Federal Reserve is looking at challenges to the dollar's role. Oh, let's put it up on screen. Okay, looking at challengers to the dollar's international role. Let's zoom in a little bit here. All right, so obviously with the DXY up today, this isn't really what they were talking about. This is a little bit of an older study that they're talking about here. But they're looking at factors that could erode the international use of the dollar over time. So we're looking at sanctions on Russia have encouraged de-dollarization straight from the Federal Reserve, looking at the risks of global de-dollarization as a result of countries realizing you can't trust the dollar anymore, because if push comes to shove and you end up being the United States enemy, you might not be able to access or use your dollars. So that is an incentive for people to say, hey, we need to potentially de-dollarize so that we are not vulnerable to that if it comes to it in the future. They also pointed out risks with cryptocurrencies. CBDCs could supplant the dollar's cross-border role in payments. With specifically CBDCs, this is something I made a video about before, but you have SWIFT right now trying to develop the technology to become the intermediary between CBDCs. So if every single country develops their own CBDC, technologically speaking, they might not communicate that well with each other. And so for cross-border payments, a CBDC from Germany might not work that well with a CBDC from China. So you have SWIFT coming in and saying, hey, we want to be that middleman so that CBDCs can communicate with each other and cross-border payments are really easy. Really just trying to maintain their monopoly on global dollar transactions like they have today using SWIFT. Trying to make sure that they don't lose that with a transition if countries start moving to CBDCs. And then let's see here. What else did they say in this article that I wanted to point out for you guys? So they said no currency replicates the characteristics of the dollar as a store of value, unit of account, and medium of exchange. And part of this is if you look at Ray Dalio's he's got two books that I love. One of them is Principles of Navigating Big Debt Crises, and the other one is The Changing World Order. And in both of them, he talks about the cycles of empire and breaks it down from like the rise and fall of a global power, what the different parts are of that global power and when they rise and fall within the lifespan of that empire. So it looks at things like military and education and that nation being the financial center of the world, things like that. And then, so when you look at the global reserve currency portion of it, that's like a lagging indicator. So a country that is the rising superpower or the new superpower doesn't get the global reserve currency typically until much later into the lifespan, where it's basically already the superpower. And then the one that's old one that's falling usually maintains that status for much longer. So if that's really like when you see countries where it's like that's the only thing that they have left is, hey, at least we still have our currency is a global reserve currency. That's an indicator that the power is done. It's like at the end of its life cycle. And similar to it being the financial center of the world, that's a lagging indicator as well. And so the very fact that we're looking at that in terms of the dollar right now is a sign that the global status of the United States versus other powers is on the decline and potentially close to over. The next thing that we're seeing here going on today is the delayed coupon payments for Gazprom bondholders. So they this is I think I talked about this before as well, but maybe I didn't. I might have just tweeted it. If you look at what Russia is saying, they're saying, hey, we wired the money that was due last week. The problem is because of sanctions, we are seeing that the intermediary, the one that distributes those payments, is basically holding them. And the article says to do their due diligence, but they're claiming default, saying that Russia has defaulted on its payments. But Russia's saying, no, we sent them. You're the one that's not allowing those payments to go through. So pointing fingers here. Ultimately, we'll see how it plays out. But that's another thing happening right now that points back to what we were talking about earlier about the potential risk for global de-dollarization. If you can just force someone to default, even if they pay, you just say, hey, we're not going to let that payment go through. And they're saying, hey, we're trying to pay, but they're not letting that payment go through. You're forcing default. But is that really a default? Because they actually had the money to pay and they tried to pay and then you just stopped it. So we'll see. All right. What's the next thing going on with the dollar right now? All right, this from Yahoo. Recession fear puts dollar on course for the biggest gain since 2020. Again, a very big gain, and that's significant. So if we look at the dollar's price action, the DXY's price action, the last time a move like this happened was in 2020 when the dollar was spiking, and typically central banks don't want their currency to do this because it makes life harder for everybody else. The dollar is the global reserve currency. It's used for almost all international trade. And so for any country to be able to buy things from other countries, what you have to do is you have to get dollars first. And so if you're a developing market, if you're an emerging market and you need to buy oil, you need to buy gas, you need to buy food, you're importing things, you're going to take your currency, you're going to switch it out for dollars, then you're going to use those dollars to go buy the thing that you need. Well, if it takes more and more and more units of your own currency in order to get dollars, that means everything else gets more expensive. Everything you have to import gets a lot more expensive. And so if you're a country that hasn't saved up a lot, doesn't have a lot of your own resources, isn't financially the strongest, maybe you have to resort to printing more money in order to get dollars. Well, all that does is devalue your own currency against the dollars. And so it makes the problem even worse. And so you have a big problem in emerging markets and developing markets right now as the dollar gets stronger and stronger. All right, let's look at bonds. We've got the 2-year at 2.8 and the 10-year at 2.7. So we've got an inverted yield curve right now. Typically with debt, you would expect that the longer the duration, the higher the interest rate. But when the 2-year is above the 10-year, that is called an inverted yield curve because if I borrow money from you for 10 years, there's a bigger risk that you're not going to be able to pay me back compared to if I borrow money from you for only 2 years. Because there's more time for something to go wrong. And so the interest rate on the longer term debt is going to be higher. That's why if you go get a 15-year mortgage, you get a better interest rate than a 30-year mortgage typically. But when the 2-year is above the 10-year, then you are not seeing something that is a free market phenomenon. You're seeing expectations of intervention because we're seeing tightening. We're seeing things get expensive. We're seeing recession warnings happen. We're seeing things get tighter, unemployment, layoffs, all this crazy stuff. The Atlanta Fed says the recession is probably already here because the GDP contracted in the first quarter, and they're saying, hey, we think that the GDP contracted during the second quarter as well. So based on that, they're saying, hey, well, there's a chance that the Fed lowers rates in the next 2 years. There's a bigger chance that the Fed lowers rates in the next 10 years. There's more of a chance of something going wrong. And then the Fed would have to lower interest rates to deal with it. So that's where the inverted yield curve comes from. And that's why it's a recession indicator, that when the 2 and the 10 flip and become inverted. Now we'll see if this sustains itself. We've seen the flip happen a couple of times over the last couple of months, and it hasn't stayed. It hasn't stuck. But if it sticks this time, then that's a solid indicator of a recession. In fact, an inverted yield curve between the 2 and the 10 has preceded every recession in the last 40 years, 50 years, I think. It has happened a few times without a recession following. But every time there's been a recession, it's been preceded by an inverted yield curve. So they say that an inverted yield curve has preceded 9 out of the last 7 recessions, because it's happened more times than recessions have. But every time a recession has happened, it's been preceded by an inverted yield curve. All right. What else? I wanted to talk about MMT. So modern monetary theory has been, it was kind of like, we got the closest to full out MMT over the last couple of years than we ever have in this country and many places around the world. MMT basically says, hey, the national debt isn't real if you have a central bank and you're borrowing in the same currency that your central bank prints. So if we were borrowing euros or yen or rubles or something else, it'd be a different story. But since the government borrows dollars and the government controls the central bank, the Federal Reserve, which prints dollars, then the debt's not real. It doesn't need to be, there's no risk of defaulting on that debt other than just through lack of political will to correct that action. Because at the end of the day, if they owe $1 trillion, push comes to shove, they can say, Federal Reserve, print us $1 trillion, pay that debt for us. Now, there's legal loopholes, legal limits and fences that prevent that thing from happening, because when they started the Federal Reserve in 1913, everybody was worried about that. So they said, hey, we're going to put all these legal things in place to prevent something like that from happening. Otherwise, the government has unlimited spending power and they can inflate away our currency. And so they didn't want that to happen. So they put all these laws in place to prevent that from happening, that we've slowly been finding loopholes around and stepping over for years and years and years. So at the end of the day, Congress can just say, okay, Federal Reserve, we are taking control. We're going to fold you under the Treasury so that we have full control over printing money and what that money goes towards, and ultimately just print money to pay the debt. So the debt itself is not real in terms of being at risk of default, because they can just print the money, which means that as long as you go over those legal limits, MMT says that there's no constraints on government spending other than real resources. And so this gets to the debate between decentralization versus centralization, which one is better and more efficient and more effective at creating prosperity. And the MMT camp says, hey, if we centralize the decision-making on how to allocate resources in an economy, that's the most effective and efficient way to do this, because the government, when the government spends money, that's money that goes into somebody else's account. Just like when I spend money, if I spend money at a business you own, that's money that leaves my account and goes into your account. And so any negative for me is a surplus for the rest of the economy. Any negative for the government is a surplus for the rest of the economy. And so they say that they can print as much as they want as long as the spending decisions that they're making with that money are things that are boosting the economy. So spend it on infrastructure and education and things that will be beneficial to society, provide a foundation that allows more and more prosperity. And really the underlying assumption there is that centralized decision-making on the allocation of resources is more effective and more efficient than the decentralized choices of every individual. Because ultimately, at the end of the day, when you spend money that's been printed into existence, what you're doing is reallocating resources, because any money that is printed only has purchasing power as a percent of the existing pool of money. So anytime you print money and then spend it, you're removing purchasing power from the existing pool of money, transferring that purchasing power to a different area, and affecting the flow of resources in a way that would not happen naturally absent that spending. Because if it would have happened naturally absent that spending wouldn't have taken place. You don't have to get taxes and city grants and city subsidies in order to build a stadium if the company is going to do it for free, because, or not for free, but if the company is going to do it out of their own revenue and out of their own pocketbooks, because the company then does it. But if the company then looks at that and says, no, it's not profitable for us to spend that money on it, so they get the city to pay for it, well, then by nature, that's an unprofitable thing, because that money that the company who cares about profits didn't want to do it. So it's less profitable than what that money would have been spent on otherwise. City paying for that out of taxpayer dollars is literally just forcing that to happen. And so you have the same exact dynamic happen when the government prints money to spend money. You're just taking purchasing power away from the rest of the pool of wealth, diverting it somewhere else. So it's a wealth transfer. So what it always boils down to is whether central planning is more effective and efficient than decentralized decision making from all individual actors acting in their own self-interest out of subjective values and needs and wants. So that's what it comes down to. And so they say, we can argue that all day, but that's the disagreement between free market and MMT. Now they say, then you say, okay, well, what is the limitation then if it's not a limitation on spending or debt or inflation? Because if it causes more prosperity, then it's not going to cause inflation, because the wealth and goods and services will increase faster than the amount of money supply. Then it wouldn't cause inflation. It might even cause deflation, theoretically speaking, of course. And so their constraints, then they say, are constraint on resources. So if you get to the point where you have overheating in certain areas where there's not enough resources to meet the demand of the extra government spending, then you get inflation in those areas. And so the resource constraints are the real resource constraints are the only constraints on MMT, on government spend, printing money into existence. And really, it's kind of a sleight of hand there, because that's the point. The point is that resources are scarce. That is the absolute base default level of civilization, society, of wealth, of economics, is poverty and scarcity. That resources, usability and accessibility of resources are scarce. You have to go out and use labor and capital and time in order to produce those into wealth in a way that eventually creates wealth and abundance. And so the accessibility of real resources is the constraint. And so that's the whole point. And so what free market advocates say is that any government spending is by nature less profitable and by nature more wasteful of those real resources than allowing things to be decentralized and chosen from the bottom up rather than the top down. And so you will get less efficient and less effective allocation of resources that will result in higher and higher prices on those resources, that will result in shortages and then prices spiking. And so basically, MMTers say, hey, the only limit on government spending is real resource constraints. And free market advocates say, yes, but that will happen. It's not like you can get around that. And so that's what we've seen over the last couple of years. We ran an experiment. We increased the money supply by 40%. And guess what? Real resources dried up suddenly, magically, for no apparent reason. There's shortages everywhere you can look. There's shortages in labor. There's shortages in chips. There's shortages in energy. There's shortages in food. Everywhere we look, there's not enough stuff. That's the constraint. That's the real wealth. That's the stuff. So when you increase the money supply, that happens. And so now what we're seeing is the unwinding of that, because they can't come in and bail out again as things are collapsing. Otherwise, you get the hyperinflation, because we have the inflation now. And so we're seeing things collapse. And now the central banks around the world are saying, well, we have to let them collapse. And we're getting back to what we saw right here, where the dollar is doing something that it hasn't done since 2020, and we're above that, where they had the ability, the real resources freed up to come in and try and bail out the system, push the dollar down, right? But now we're seeing an unwinding of that. And now that conditions are even worse than they were back here, they don't have the ability, the resources, the idle capacity, if you will, to come in and bail out. Otherwise, everything just explodes in prices. So they're between a rock and a hard place right now of their own making. And MMT has proven to be both true and false, right? Because all the base assumptions that they were saying were like, yeah, that's true. The only constraint on spending is political will to create more money, and then the only real constraint on that after you leap over those political constraints are real resources. And it's like, well, yeah, of course. We're not debating that. We're just saying it's going to result in wealth destruction, and you're saying it's going to result in prosperity. And so that's the big disagreement. Okay, finally, let's go to how inflation persists with rising income. This is going to be the last thing I want to talk about before we end the stream here. How inflation persists with rising income, because that's really the only way that inflation persists, because inflation is rising prices. So that means people have to be buying the stuff at those rising prices. Otherwise, prices can't continue to rise. And so you look at prices that keep on going up and you think, okay, how high can they go? Because eventually it gets to a price where people can't afford them. And for about 2 years, we had rising incomes that sustained those rising prices. And at the beginning of 2020, everybody was saying, well, you need employment to go back up in order to have sustained inflation. And that's exactly what happened, right? People had their incomes sustained by government handouts for a while. And once those went away, those people started getting a bunch of jobs and pay raises. We had a lot of churn in companies, so incomes kept on going up, and that supported the continuation of buying things, especially the necessities. So incomes go up during inflation. That is the hallmark of inflation. Otherwise, the inflation stops if incomes stop going up. And when incomes stop going up, either through layoffs or government handouts stop, then the inflation will have to stop, because you don't have a continuing increase of the money supply by the spenders. The caveat to that is if you have incomes go up, but people don't spend it. So like Japan over the last couple decades, incomes have been going up, but the people have been deleveraging, and companies have been deleveraging, and people have been saving, and companies have been saving. So you have money trying to enter the system by the central bank, but people are saying, nope, we're just going to keep that out of circulation. So they weren't spending it. This is where culture plays a big role in this, because when Americans get handed a $1,200 stimulus check, they go buy a Gucci bag with it. When Japanese people have gotten money over the last, couple of decades from easy conditions, they put it in the bank and save, and they pay off their debt. So very big difference in cultural approaches to finances. So when we look at inflation right now, the question is, how long can inflation persist? And the answer is as long as incomes keep on going up. And incomes will always go up during inflation, but they might not go up at the same, to the same extent, and they haven't for the last 2 years. And so at some point that catches up with itself, and prices have to come back down. But then you have the pain enter. And so when we look at countries that have had massive inflation over the last a couple of decades, you always see incomes, at least in certain areas, go up in order to short-term deal with the problems. So you get subsidies, you get, subsidies on gas and food and bread, you get handouts, you get rebates, you get things where, at least for certain things, incomes are sustained by the government. And so we're seeing in California, they were doing, or at least talking about, I don't know if they actually ever did it, sending out like little gift cards for rebates for gas prices. Biden talked about that like 2 weeks ago. He was saying, hey, we need to give people money for gas prices. And we're probably going to see the same thing happen within the next year with housing prices. People can't afford houses, especially if interest rates stay this high, and especially if we don't get a massive crash in prices. We have a huge portion of the population that is priced out of the market. And so you might have the government come out and say, hey, we're going to do, everybody easy 40-year mortgage, no money down, down payment assistance, 2% interest rates, whatever, where you artificially increase the purchasing power for a certain area to help out the little guy. All that does is funnel more money into that area and push prices up even more, makes the problem much worse. And so we are seeing things like that being talked about. Nothing is happening yet, but if the pain gets bad enough, the free market thing would be prices would fall. You could have the government come in send out more free money in those specific areas, that would sustain the inflation in those areas. So as long as incomes keep on going up, whether it's broad income or focused income, inflation can persist. So that's what I wanted to talk to you guys about today. The dollar going up at the end of the day is breaking all sorts of markets. Asset prices are starting to fall. This is the last thing, actually, real quick. This is, if not now, very close to massive opportunities. People make money during bull markets and make fortunes during bear markets. That's when the deals come about. And so when you are looking at markets crashing, that's top down. You're looking at the macro environment around the world. You're looking at sectors and industries and markets. Things are falling. Then you take a bottom up approach and you start doing fundamental analysis, looking at the balance sheets, looking at the financial statements, saying, hey, these companies are on sale. It's not just like, hey, this is an unprofitable company that has no business plan, will never produce a product, will never produce profit, and they've fallen 90% from the top to the bottom. That doesn't matter because they can fall another 90% from there. And guess what? After they do that, they can fall another 90% from there, right? You can always fall another 90% until you get to like 1 cent, and then you're at a fraction of a penny or whatever. Then you have to do reverse stock splits, and then you can still fall another 90%. So the thing to do is really start looking at this as an opportunity to buy value stocks, to buy companies, fundamentally use fundamental analysis to analyze the companies, look at their financials, look at their earnings, look at their growth, look at their moats, look at the businesses that they're in, saying this is a profitable company, little debt, cash flow, look at their the amount of cash that they have on hand, look at how resilient they are to recessions in the past, look at their exposure to certain currencies and sanctions around the world, and buying companies at a discount, because this is when, all the classic things that the most successful investors talk about all throughout history is number one, buy when, like Warren Buffett, buy when there's blood in the streets, even if it's your own. And so the way to know that is to look at the value of the company. Don't just look at the price, look at the value of the business and see if it's underpriced or if it's still overpriced. You also have to, another Warren Buffett saying is, when the tide goes out, you can see who's swimming naked. And that's exactly what's happening right now. You've seen 70, 80, 90% drops in companies that were valued at, these crazy valuations for potential growth way off in the future. And now that conditions have gotten to the point where there's no more free money floating around, they don't have a business plan. And so this is the opportunity. This is the time when you can start really looking at companies and finding value, finding deals, finding discounts. And it might be a long time before you're proven right. But in order to win at investing, this is Ray Dalio, you have to bet against the consensus and be right. You're not just contrarian, you're a contrarian and you're right. Because ultimately, when you buy something, you're buying it at the price that is the consensus. Everybody agrees at that moment, that is the fair value price. All the buyers and all the sellers, all the potential buyers, all the potential sellers have found equilibrium at the current price. When you buy something, you're saying all the potential buyers and sellers out there are wrong. And I think in the future, this will be higher, because all the sellers are saying, I think in the future, this will be lower. And so you can do that. It might take a long time, might take a little bit of work to learn how to value companies, learn how to read the statements and look at them and say, with some sort of education rather than just a blind guess, this is a good company that will survive into the future and thrive, especially as the competition gets weeded out. So I think this is a massive opportunity, and the lower markets get, the better opportunity you have, the more opportunities you have to find value. And again, that's why they say that people make money in bull markets and make fortunes during bear markets. So that's my spiel. I really appreciate you guys all hanging out with me here during this live stream, and stay strong, keep an eye on the markets, and hopefully all of you guys are able to find deals here and have some free powder in order to get these deals, because we are slowly and surely getting into that point where we're going to see some deals of a lifetime here. So thank you so much for joining, and I will see you guys next time.